Well, ladies and gentlemen, it is indeed cold out there, so the timing of this webinar is very pertinent. Good afternoon and welcome to the final Master Investor webinar of the year. And in many respects, due to the war in Ukraine, energy security has become critical. But is that to the detriment of those involved in the oil and gas sectors and those who invest in them? Well, in today's webinar, we're going to hear from several companies who are thriving in this environment. So the format is each presenter will get 15 minutes and then there's 5 minutes at the end of each presentation for you to ask questions, which you can do so in the chat box if you are watching this live on the Zoom platform. Okay, first up, and it's ADX Energy. It's an ASX listed oil and gas exploration and production company focused on projects in Austria, Romania and Italy. Its portfolio represents both onshore and offshore energy operations, but the company is transforming its business to focus on onshore exploration, where it believes it can achieve more rapid returns on investment and cash flow growth. Ian Tchacos is the executive chairman. Ian, thank you very much indeed for joining us, and it's over to you.
Thank you. Okay, look, ADX is a bit of an anomaly. We are an ASX listed company, but our focus is totally on Europe, we, I guess, have moved around a little bit. We started very much focused on, as Sarah mentioned, offshore Italy, offshore Tunisia. But then we realised some years ago that onshore is just a better place for us to be, and we could progress much more quickly in terms of developing an asset base. So where we are right now, we're focused primarily on Austria. There we produce safe, long-life oil and gas. We're developing new energy resources through recent discoveries. And now we're also in the process of getting ourselves in a position, due to the energy crisis, to drill very high-impact gas wells as well as low-risk exploration. But in that process, Austria provided us also with the opportunity to upcycle and redeploy both our assets and our people for long-term, low-carbon energy projects. As you can see there, ESG commitment is very important to us. It is our license to operate. It's very important, for the communities in which we operate, and that's very much an increasing part of our business, as it has to be for everyone. Our corporate overview, as I mentioned earlier, we're in Italy, we're in Romania, but the focus is very much on Austria, where we have a number of projects. Right now, we're producing around 330 barrels a day of clean oil in Upper Austria. It produces very high environmental standards. We've also had a recent discovery which has increased our reserves base up to about 5.9 million barrels. And we've also got a prospective resource base of around 200 million barrels. And alongside that, we've got around 47 megawatts combined clean energy projects that we're trying to take through to FID. The company has got quite healthy cash reserves with the production and the oil and gas prices we're achieving. We're building our cash position all the time. We're getting healthy cash flows, and we've also been able to retire over $2.5 million of debt very recently. So that puts us in a very strong financial position. And that position is also supplemented very nicely with some of the farm outs that we're able to achieve. So really there's three pillars to our business. There's production. We're currently producing around 250 barrels a day from our Vienna Basin fields, another 80 barrels a day net from a new discovery, our first well, and that gives us all up around 5 million barrels of oil reserves. I mentioned earlier, we've got a very high impact gas prospect, the Welchow gas prospect. We expect to be drilling by middle of next year, and that's got about 800 BCF of prospective resource, best estimate located right in the centre of Europe. In addition to that, we've got around 650 million barrels of oil equivalent of drill-ready portfolio ready to go, and that's getting a lot of interest from potential farminees and to join us in that portfolio, and we expect that we'll be making more announcements along those lines as well. Coupled with that, we've got our green hydrogen production and storage project that we're progressing in the Vienna Basin, a 200 megawatt solar park in support of our oil and gas fields also in the Vienna Basin, and a 15 megawatt geothermal project in Upper Austria around our exploration acreage. What's really important is these green energy projects are very much part of what we're doing. They're not, if you like, new projects to transition. They're actually integral to our existing projects. So we're just really upcycling our existing projects as we go forward. So what we're trying to do is really transition through value addition rather than going into new areas that we really don't understand. You can use oil and gas reservoirs for a number of things. You can use them for storing carbon, you can use them for storing hydrogen, and you can also use them for geothermal. And we're looking at doing all of that. But what we're really trying to do right now is build our production base, build our conventional energy base, and while we're doing that, able to reinvest some of those funds into developing complementary renewable energy projects that will give us longer term value and enable us to, in fact, extend the life of many of our projects and redeploy our operational skills that we have primarily in Austria. So why Austria? Look, Austria is a hidden gem. A lot of people wouldn't even know that a very substantial oil and gas province has existed in Austria because it's been dominated by two companies, OMV, the National Oil Company of Austria, and a private company called RAG, which was a consortium of Mobil and Shell. 3 years ago, we broke into that duopoly by the purchase of our little Vienna Basin oil and gas fields. And since that time, we were also able to expand our asset footprint to Upper Austria, where we've been able to build a large exploration position at 100%. And that was enabled because we had able also to get our hands on around 3,500 square kilometres of 3D seismic. What we have in Austria is not only very good prospectivity with a 50% success rate historically on 3D, but we have excellent access to infrastructure. We've been able to negotiate infrastructure arrangements up front. So when we had our recent Anshoff discovery, we've been able to start production within 9 months, and that's very difficult to do in most jurisdictions. As you can see, we've been very busy. We started in December 2029 with the acquisition of our fields. In January 2021, we progressed with the Vienna Basin hydrogen project. We were awarded acreage in 2020 because we had access to 3D seismic. And then in 2021, we were able to farm out the Anshoff oil prospect and drill it in January 2022. So we were able to drill an oil prospect within 12 months of actually acquiring exploration acreage, which is almost impossible to do. Usually the life cycle from acquisition of a license to drilling is somewhere between 3 to 5 years. And now in September, we found ourselves in a position where we were able to assemble an early production unit. And in October, we started producing that discovery at around 100 barrels a day. And then more recently, we announced a farm out to a group called Kris and Pobe, who are going to join us on a 2-for-1 basis, where they'll fund 50% to earn 20% in our giant Welchow prospect, with the option to take that to funding 100% for a participation of 40%. So we not only have a lot of activity, we also are able to secure these farm outs, which provide us with sources of funding rather than having to go back to our shareholders continuously to source capital. But I guess the reason we're all here is the growth we've seen in energy prices, not only in Europe, but elsewhere on the planet. But the area of greatest interest is obviously gas. And look, I think what we can see there is the build-up of gas prices in mainland Europe. And what we're looking at now is a forward curve with equivalent price of around 355 barrels of oil equivalent looking forward. That's very exceptional. Historically, most oil and gas companies were happy to operate, with a gas price of somewhere between 10 to 30 euros per megawatt hour. Now we're looking at prices between 100 and 150. Now, it's not going to last forever. We know that. I mean, I think Europe has been getting drunk on Russian gas for too long, and we will find alternatives. And one of the alternatives is stepping up exploration. And that's certainly what we're planning to do. What you see here is a bit of a snapshot on our Vienna Basin oil and gas fields. We hold those at 100% interest. They're long life fields. They've been producing since the 50s. They're multi-layered reservoirs. And basically, since we've owned those fields, there's been virtually zero decline. We're also blessed by the fact that they are very, very well run facilities to very high environmental standards. But also, they give us a substantial future because these fields will last probably for another 10 to 15 years at current oil prices. There's excellent fiscal terms. But because we've got multi-layered reservoirs, some of which are depleted, we can also utilise some of these reservoirs for hydrogen storage. And that's what we're considering with our Vienna Basin hydrogen generation and storage project. We're also surrounded, as you can see, by some of the largest wind farms in Austria. So that also gives us access to green power that we can use to generate hydrogen and store in our fields. Now, there's a lot of talk about hydrogen backbones through Europe, and we're very well placed within 70 kilometres of Vienna, who wants to be, by 2030, a hydrogen hub. So, yeah, we're really looking forward to doing that. We're also looking to add a solar farm. The reason we're doing that is with most oil and gas fields, you have quite a high energy demand. And what we're trying to do is replace, if you like, buying electricity off the grid with our own generated power, which will not only reduce emissions, but also reduce operating costs.
You've got 2 minutes left, Ian.
In the Anshoff field, we were very fortunate to have a discovery early this year. The field is currently producing at 100 barrels a day. We've got about 5.2 million barrels of oil independently assessed, but our 3C resources and reserves could be up to 25 million barrels. So we've been able to fast track this project, and we're looking to drill 2 more wells in the coming year, which we expect will get us up to around 1,000 barrels a day. So this is not only a very big addition of cash flow for us, but also could be a very big addition of value, again, right in the heart of Europe and with access to infrastructure. We also have a very nice acreage position. As I talked about earlier, we've got a very substantial portfolio that's ready to drill. We've got 16 drill-ready prospects, including the Welchow gas prospect. And we've been able to fast-track the appraisal of these opportunities, and we're looking to take this forward with additional drilling in the coming year, where we expect to be drilling up to 5 wells, 2 on Anshoff, a Welchow well, plus 2 other exploration prospects. I'll just talk briefly about Welchow, and then I'll leave you. I'll leave the exciting prospect for last, but it's 800 BCF of energy equivalent, gas equivalent. It's in a giant thrust anticline. It's adjacent to a proven gas field that was discovered in the 80s but not developed. And that field encountered over 400 metres of gas. It produced gas with high condensate ratios. We're up-dip from that, less than 2 kilometres. So we're chasing similar reservoirs at a shallow drill depth very close to infrastructure, and very cheap to drill. So that's a very exciting prospect for us, and we're very much looking forward to drilling that prospect in the near future. I'll stop right there.
Many thanks, Ian. So you can stop sharing your screen there. There you go, I can see you, which is great. So one of the mantras of your company has been reliable energy doesn't need to cost the earth. And one of the recent investor updates was that you were ordering long lead items for the drilling of Anshoff 1 and 2 wells. So I'm just wondering, with inflation, is the cost of those long lead items eye-wateringly expensive?
Look, in some instances it is. Also, we're also very fortunate in Austria, where we work with a much larger operator from which we purchased our fields. So we tend to purchase equipment with them. So we're able to get pretty good rates. So we've also got a bit of an inventory that we've been able to lean on, but I would say probably long lead items are probably 15 to 20% increase in cost. But the biggest issue is actually the lead time. So we've been able to go out, order these quickly to be able to meet, if you like, some of these drilling if you like, opportunities that we have in front of us. So a lot of our cash flow that we've been generating has been going into setting ourselves up for a very active program. In the case of the Welchow prospect, we were able to get actually equipment from Romania, and we'll be drilling that well with equipment from Romania.
So good rates, I'm assuming good relationships. And I'm wondering if you've got good relationships with the banker, because you referenced there that you've managed to retire $2 million of debt. How was that achieved?
Yeah, well, look, primarily thanks to increasing oil and gas price, to be honest, and the reason has been that we've been able to generate strong internal cash flow, not only to fund our operations but also to retire debt. So that puts us in a very good position. And look, I think you're right. We do have very good relationships. When we purchased our assets, we were also able to get people from the previous operator who virtually got out of exploration. So we were able to get a ready-made exploration and production team in Austria that we've been able to deploy across our asset base, and that's enabled us to do things much faster, but also have much better relationships with the Austrian authorities, which is obviously critical.
It certainly is key. So we've got a couple of questions from our audience. Morris says, share price appears to have oscillated around 0.007 for the last 10 years, and you don't seem to pay a dividend. Why should one invest in ADX?
Yeah, look, that's a very good point, and it's a very big focus of what we're doing. I mean, to be fair, the company's actually gone from offshore exploration, where it had mixed success. Again, we had mixed success in Romania, but we believe we've really found a gem in Austria. We're not having to go back to shareholders to fund our programs looking forward. So I think what shareholders will see is a very strong activity profile going forward without the requirement to go to shareholders. And usually what we see with junior companies like ourselves, it's all about drilling activity. That's what people want to see. They want to see volatility events. But what's going on in the background is also, as you have observed, Sarah, is we're generating strong cash flow, so we can do a lot more ourselves rather than needing to rely on equity.
Okay, so it was a bold move to transform, but it looks as though it was the right decision. Do you think you have the company making asset in the portfolio yet? Which one might it be? I've got a suspicion I know what the answer is.
Well, look, I think everyone would look at Welchow because of the gas situation, but we can see very strong evidence that Anshoff could be as much as 25 million barrels of oil. 25 million barrels of oil onshore is a company maker in itself. We've discovered that field. We'll be further appraising and developing that field. But of course, Welchow will be a very, very exciting drill in the middle of next year.
Excellent. Ian, thank you very much. I know it was rapid, it was a short amount of time we gave you, but we have got the essence of the company's prospects. It has been an absolute pleasure. Thank you for joining us. Much appreciated.
Pleasure, Sarah. Thank you very much.
Thank you. Well, Ian referenced the bigger picture there. So we're actually going to have a macro interlude before we engage with Hartshead Resources and Botala Energy, because we now are going to be joined by Callum Macpherson, who's head of commodities at Investec. Thank you very much indeed for joining us, Callum. You know, well, Ian's talked about, you know, Russia's invasion of Ukraine and the energy crisis, you know, some in Europe are facing because of this. But in terms of supply and demand and the price for oil and gas, who actually holds the keys? Is it Russia, China, or OPEC?
Oh, Sarah, thanks very much for having me. It's great to be on to be able to talk about these things. Well, I think all of them hold a very significant influence. If we start with China on the demand side for oil, China is really one of the key uncertainties at the moment. So total global oil consumption is around 100 million barrels per day. China accounts for around 15% of that demand. And at the moment, or over the course of this year, it's probably using maybe 1 million barrels per day less than it might have been doing if it were not for all these COVID restrictions and all the rest of it. Now, 1 million barrels per day doesn't sound like that much, perhaps 1% of total demand, but actually if we have a surplus or deficit of 1 million barrels per day, that is actually pretty significant in terms of the price range it could drive for Brent or other crude references. So China's a key question. Obviously, there have been the protests and now some easing in lockdown measures, and that sounds like that should be a good thing for demand. But that's not necessarily the case if it leads to outbreaks of COVID and stricter lockdowns. And the problem that the Chinese have is that a lot of the elderly people are not particularly well vaccinated, and potentially the vaccines are not very good either, and they won't use foreign vaccines. So there's an awful lot of uncertainty about exactly how things are going to play out for China over this winter. Then turning on to the supply side, now obviously Russia and OPEC have joined together in this OPEC Plus group with some other non-OPEC members as well. And at their OPEC meeting in October, they decided to cut output limits by 2 million barrels per day, which we think probably lead to something like 1 million barrels per day of actual production cuts in November, because a lot of the members aren't producing up to their limits. But if OPEC were to go further in cutting output limits, then a lot more of the members then would start to have to reduce actual production. So it becomes a much more complicated discussion than the last one, which was really about Saudi Arabia and the UAE putting through production cuts because they were actually up to their limits. So I think it becomes more complicated. Then on gas, certainly as far as Europe is concerned, I mean, Russia clearly has the keys, there's no doubt about that.
So I'm just wondering, going forward, what will influence the prices of oil and gas? Will it again be influenced by inferior vaccines, COVID vaccines in China?
Yeah, well, I think going into next year, the China reopening is probably the big story on the demand side, which we've sort of talked about. I mean, presumably there will be a reopening and demand will increase, but exactly how smooth that is and when it happens, that's really the area of uncertainty there. And then on the demand side, more generally, there's a danger of global slowdowns and things like this, which could be an issue. But I think certainly there's, if China does reopen and we don't demand more broadly remains reasonably solid, then we could actually see the market being the oil market being a significant deficit, reasonable deficit next year. So it could be quite supportive for prices. Then on the gas side, well, we get through this winter. Somehow we have some inventory left, but then the question is, how do we rebuild that inventory? And we're going to need to try and do that in Europe. Although we've had interrupted supplies from Russia for about 12 months now, the fact is through the first half of this year, actually there were good supplies, well, reasonable supplies of gas coming in from Russia. We're not going to have that next year, I think it's fair to assume. And on top of that, the other consequence of the Chinese reopening would be more Chinese LNG demand, so additional competition there for cargoes of LNG. And it seems quite plausible that next winter might be even more difficult than this one as far as gas is concerned.
So I know within our audience, there are investors who invest within this sector. So how are oil and gas prices interacting with other markets like equities?
Well, for oil, usually is quite strongly correlated with equities. So if you have a macro environment that is bullish and positive, you get equities going up. That's good for oil, an environment that's good for oil. And so oil prices tend to go up as well. So they tend to be positively correlated. But that sort of breaks down when oil prices get so high that it actually really damages the economy. And of course, that's what we've been having over much of this year. So they've been negatively correlated. Now we're back with Brent at 80 or even below 80 this morning, dollars per barrel. Then we're perhaps starting to get back into this other mode, and perhaps they'll become more correlated again. We'll see, particularly if there's the China reopening and so on. So that could happen together. On gas prices, though, I think there's potentially a much more a serious impact for perhaps equity markets, because we have a situation where gas prices and electricity prices in Europe are maybe 5 or have been 10 times as expensive as they have been in the US. So that opens real questions about the sustainability of European industry, energy-intensive industry. Is a massive economic advantage for the US, where they have cheap energy, and if this situation persists, which it does seem like it could well do for next year, then I think that will have significant implications for company valuations and so on coming out of that. I think you enjoy your own conclusions.
So I'm just wondering, what do you think about the reaction of the policymakers in Europe in terms of how they are dealing with the energy crisis?
Well, I think they've tended to look at it as being a problem of market design. They've seen these very aggressive swings in gas markets and thought this is a bit crazy. It's to do with speculators and all the rest of it. But the simple fact is that if you've got a situation where consumers are trying to consume more gas than you have available, whether that's in storage or current supply, and particularly if you're offering subsidies to enable people to continue buying, even if prices do rise, then you have a situation where prices can get to arbitrarily high levels. So the market is really just trying to sort of cope with this situation. The only real way to address this is, and to cap prices, if you like, is to try and manage down demand. But of course, that's very painful to do. And that's, of course, why politicians have tried to look for these other options, unfortunately.
So as we're going to learn from some of our presentations within this event, it's not just traditional exploration and production these days, is it? Because oil and gas companies are expected to continue to navigate the energy transition. And I'm thinking they have to adapt to the impacts of carbon emissions, hydrogen, and integrated refineries. There's a lot to consider.
Yes, and I think actually following on from the very interesting presentation by ADX, we focus on Europe, and obviously they're doing a lot of very, very interesting and innovative things. But it's worth remembering that generally European oil and gas production is relatively low carbon compared to other available sources, because we have strong restrictions on flaring and things like that. So a lot of progress has been made, and more can be done. It's particularly noticeable if you compare it to LNG. So if we're going to liquefy gas and transport it and regasify it, that's a very energy intensive process. It has a large carbon footprint, and consequently, it makes a lot of sense to use domestic European gas in Europe. But I think then more generally where we go from here in the energy transition, a lot of investments and carbon emissions have been sunk in infrastructure that's been put in place in the North Sea and so forth. So it makes a lot of sense to try and see if we can use that for carbon capture and things of that sort. And then just on the hydrogen question, I just sort of say very briefly that we must remember that there's an awful lot of hydrogen used today in desulfurization in refineries and producing fertilizers and things like this. And I think perhaps there's plenty to go at in terms of decarbonizing that before we start to get on to developing a hydrogen economy and changing other sources. So to me, that's where the focus ought to be.
Okay, I'm actually kind of tickled by the phrase that you've used unintentionally there, sunk into the North Sea. But finally, because we are running out of time, themes we should be aware of that will influence our investment decisions in this sector. I'm thinking inflation, cost of pipes, cost of people, and things like, you know, a prolonged war, or even, God forbid, an escalation of it.
Well, I mean, I'm not going to try and make any forecast about what's going to happen with the war, but I think the current situation we're facing is probably going to continue for some extended period, whether the war comes to an end fairly quickly or not. It doesn't look as if it will be very quick. But I think much more broadly, what I hope we sort of learn from this energy crisis, and I say we, not just people in the industry, but everybody, is actually how it's just actually how valuable energy is. We shouldn't think of this as energy, whatever form it is, as something that's cheap and easy and we can just rely on. We need to change our relationship of it and with it. And certainly any kind of energy transition, whichever path you go down, it becomes very much easier if you use less energy and if you use it in a way that works in sympathy with what's available. So particularly if we're going to add more renewables, and we will be adding more renewables, there's a lot that needs to be done alongside that to make that work effectively. Things like smart metering, so that we're not turning on our washing machines at peak times at 6 o'clock in the evening. To things like increasing connectivity between countries, so when it's windy in one place but not in another, that power can be shifted. So I think one of the main things I'd say is that in terms of investing in the energy transition, it's not just going to be about more renewables. There definitely will be more of that, and there needs to be more of that, but there's probably a similar amount of investment going to be needed in all kinds of things connected with grid connectivity and storage and smart metering and all these other kinds of things. So there's lots of interesting things there to look at. I think it'll be a very exciting space over the next few years. Very good. And yes, I'm learning to change my relationship with my washing machine. I actually own a mangle, and it certainly will be used. Callum Macpherson, Head of Commodities at Investec, thank you very much indeed for that macroeconomic overview. I'm much enlightened. Thank you. Thank you. It's been a pleasure. Thank you. Okay, so we've had the macroeconomic perspective, and listen out for some of those themes, which no doubt will be referenced in our next company, which is Hartshead Resources. It's 100% owner and operator of license P2607 in the Southern Gas Basin. It's advancing the Somerville and Anning gas fields with 2P reserves of 302 billion cubic feet of gas to supply the UK energy market through the Bacton hub. That was the last statistic I have. I'm sure it's different now, but the person who's going to tell us is Andy Matharu. He's the Chief Financial Officer of this ASX listed company. Thank you.
Thank you very much, Sarah. I'll just share my my screen now. Hopefully everyone can see that. So Hartshead Resources is an ASX listed company. Market capitalisation about 100 million Australian dollars. I'll just flick through these next couple of slides, which are the disclaimers. You can read those at your leisure. So in summary, we are a UK Southern Gas focused development company. We've got discovered resources across several phases of assets in the North Sea. And we've been very focused on the phase one part of our development, which is the Annin and Somerville gas fields. During the last 12 months, we've made an awful lot of progress with respect to our phase 1 development. We've also had an independent technical audit of our phase 1 assets by ERC Equipoise, which have assigned 301 BCF of gas as 2P reserves. That's 52 million barrels of oil equivalent. And we've also commenced a divestment process last June with Lab Energy to look for a farming partner for that development. And whilst all this has been going on, we've also been progressing discussions with Shell with regards to the export route for our gas to find its way to market via the Bacton Energy Hub. We are in the Southern Gas Basin. It is a well-developed area in terms of gas and renewables infrastructure. So we think that we're in a very good position in terms of monetizing these assets and our gas assets, finding the molecules to market. So I think everybody is acutely aware of where we are with respect to the energy crisis in Europe and the UK, and how unlikely it is in the near term, at least, that the renewables and nuclear sector are going to address our energy needs, and that in the near term, at least, our energy needs are going to have to be addressed by importing more gas and developing more of our own indigenous gas. That has been reflected in the current pricing, which we see at record levels, and also reflected in the forward curve. And we can see there that the forward curve, even out to when we anticipate our first gas deliveries at the end of 2024, is £2.40 a therm, which is historically far, far greater than where UK gas prices have been. So talking a little bit more now about our assets and the portfolio. This is license P2607 in the Southern Gas Basin. We are 100% owner and operator of this license, and we like to think of this as very much a portfolio and not a project. So there's 3 distinct phases. The first phase, phase 1, is the development of the Annin and Somerville gas fields. These are formerly produced fields from ConocoPhillips that have got production history on them, and I'll come on to that in a moment. We've got 301 BCF of reserves assigned to these 2 fields. We've also got a preferred development concept that has received a letter of no objection from the UK government, from the NSTA. And we've started a divestment process to find a farming partner to continue this field into development later next year. Right behind that are our phase 2 assets, the Hodgkin and Lovelace fields. They have 139 BCF of 2C resources, and we're continuing to do more work on those fields so that once we get Annin and Somerville into production, we can put the phase 2 fields into development behind them. And then within the license area, we've got phase 3, which has exploration inventory. We've got 14 prospects altogether mapped, and they give us a prospective resource base of 344 BCF unrisked. So when you take the entire resource base of the license altogether, we're looking at nearly 0.8 TCF of gas. So it's quite a material resource for a company of our size. Just a little bit about the team. This is, I think, quite an important aspect of Hartshead. We've got, I think, an incredibly well-experienced project management team. The chaps that you see here in this slide have got between 30 and 40 years experience between them of developing oil and gas fields, and particularly gas fields in the UK Southern Gas Basin. Just a couple of notable names. Jeff Barnes, for example, was projects development manager with ConocoPhillips, and he's developed 14 gas fields in the UK Southern Gas Basin when he was at ConocoPhillips. Steve Rosa, our commercial manager, has had extensive negotiations of gas field contracts in the UK, and was also instrumental in the negotiation of gas export contracts from the Clipper South field, which is analogous to the fields that we're developing. Steve Smith, our HSC Cube manager, 40 years experience in health and safety and environmental, which of course is critical within the North Sea. So we've got a team that's been there and done it before and got a lot of experience. So we're very comfortable that we've got the skill set embedded within the team that we can carry these assets forward. So just looking at what we've done to date and what's coming up, we've achieved a remarkable amount since we were awarded the license at the end of 2020. We reversed the company, as it was a private company then, into an ASX listed vehicle, which gave us our listing and our ability to raise money on the ASX. At that time, the gas price was just 40 pence a therm. We've assembled a team of highly skilled people, as I said, that have got the experience of developments in the UK Southern Gas Basin. We've completed a CPR on our phase 1 assets. We've got 2p reserves. During that time, the UK gas price has increased to over £4 a therm at one point, and we've already commenced a divestment process with Lab Energy Partners to find a partner for our phase 1 assets. Right now we've gone through concept select, we're going into FEED. We will be looking to commence our environmental surveys, and over the next 6 months, we will be looking to complete our farming negotiations and find a partner, complete FEED, gain our phase 1 FDP approval, and take FID on phase 1 and complete our gas negotiation, our gas export contract negotiations before going into the execution phase, targeting first gas in late 2024. So just a bit of a snapshot now of the license area and how it's going to be developed. As I said, it's a multi-phase development, phase 1, 2, and 3. And our preferred development concept exports the gas through the Lehman, Alpha, and Corvette fields, which are Shell-owned infrastructure, into the Bacton gas plant. And this is why we are having negotiations and discussions with Shell at the moment in terms of that export route and the commercial terms around that. In terms of the phase 1 development, we've got a concept that has been given a letter of no objection from the UK government, which enables us to go into the FEED stage. Our preferred development for phase 1 for the Annan and Somerville gas fields are 2 normally unmanned minimum facility platforms. That means that they will have a very low carbon footprint. We would expect that most of the facilities that we need, such as compression, water knockout, and any other facilities that we need, would be provided by Lehman Alpha on from the Shell infrastructure. You can see there that through the 2 platforms, we'll be looking at drilling 6 multi-reach horizontal multi-fract wells, so 3 wells from each platform, and giving us a peak rate production of 140 million cubic feet per day of gas. So the next stages for us within FEED are completing our environmental and geotechnical and geophysical surveys, our front-end engineering design, finding a partner for this via our divestment process that we're undertaking at the moment, and looking to take a final investment decision with respect to phase 1, probably towards the end of Q2 of 2023. In terms of phase 1, the Annan gas field, this field was discovered in 1969, so it's not a new field, and importantly, it has production history. So that means that we're quite confident with respect to the subsurface and how it will behave with respect to drilling and the fracks that we're looking to put into the reservoir. As I said, we're looking to put 3 horizontal multi-frac wells into the Annin field. One of the wells that was drilled many years ago, an appraisal well, the 4917-14 well, produced at an initial rate of 14 million standard cubic feet per day and produced 13 BCF from that well. So that's a good demonstration that we've got production history from this field, and gives us confidence about what we could get from a horizontal fracked well. On the Somerville field, again discovered in 1969, so similar vintage, similar development strategy with respect to 3 horizontal multi-frac wells being exported into the Bacton gas terminal via the Shell infrastructure. The production history from the Somerville field had a well producing initial rates of over 45 million standard cubic feet per day from 2 fracs, and produced ultimately 46 BCF of gas. So as you can see, highly productive reservoirs, well understood, and with good production history on them. In terms of the phase 2 development, the Hodgkin and Lovelace fields, again, these fields have produced in the past, so they are a discovered resource. They are not as mature in terms of our technical case as our phase 1 development of the Annin and Somerville gas fields, but they have still had an assignment of 139 BCF of 2C contingent resources applied to them. In the case of Hodgkin, that's had one producer that produced 26 BCF of gas historically, and on the Lovelace field they had a single well which produced 18 BCF of gas. So again, giving us confidence that these reservoirs can produce when drilled, and it gives us an idea of what they're capable of producing. And then finally, the last piece
left, Andy. Sorry, 2 minutes left.
Finally, the last piece is phase 3, our phase 3 development, which is the exploration portfolio. Very interesting that a lot of these prospects are very close to the phase 1 and phase 2 fields, which means that in terms of drilling these prospects, it should be relatively easy and lower cost in the event of success, that they could be tied back to the infrastructure that will be laid down as part of the phase 1 and phase 2 developments. You can see there in total there's 14 prospects that have been mapped, and we've got a prospective resource inventory of 344 BCF of gas. So even if we high graded the first 3 or 4 top prospects in there, it would still give us a material volume in terms of exploration to go after. And as you can see, the chance of success, their geological chances of success are quite good, 32 to 54% chance of success, and would, as I said, be easily tied back to the phase 1 and phase 2 infrastructure. So in summary, we are a gas development company. We are a couple of years now away from our first gas. Our first phase of the Annin and Somerville gas field has progressed extremely well. There's been a lot of work conducted on those 2 fields. We've got 2P reserves on Annin and Somerville. We're in the process of farming out. We've got a very highly skilled and highly experienced management team, and we are in negotiations with Shell and their infrastructure for export of our gas to the UK market. And we are in the Southern Gas Basin, which has a plethora of infrastructure and electrical offshore renewable infrastructure, which helps us development for things like hydrogen in the future within the Bacton Energy Hub.
Lovely. Thank you very much indeed, Andy. So there was lots of, and it's very important, it's a portfolio and not a project.
Yep.
So There's lots of notable headshots in terms of key management, and there's one name that has just come into the frame. In fact, it was part of an investor update in November. Stephen McCraith, now when you secured him, he must have been doing the happy dance. He's got more than 33 years of experience in the UK North Sea, and he's going to be integral to the front-end engineering design stage of phase one. So congratulations on securing him.
Yes, we were very happy that Steve McCraith has joined us. He's joined us as our wells engineer, so he will be looking after everything with respect to our drilling discipline. As you said, he's extremely experienced, 40 years experience in the North Sea, most of that with the likes of Shell and Shell International. So yeah, we're quite fortunate that we've managed to retain his services, and he certainly complements a very highly experienced team with the right sort of skills that we need to take these projects forward.
And it's in engagements and appointments like that which indicate to me that there's a certain element of acceleration going on. So you've launched a process to find a partner for the phase one development of Anning and Somerville. So what's the current status of that process, bearing in mind I've just referenced acceleration?
Right. Well, we commenced this process for phase one and in gas fields to look for a partner. At the end of June, we announced that we appointed a very experienced A&B advisory group called Lab Energy Partners, who have done a tremendous job on this for us so far. So we've completed the first phase of that process, which was very well received. We had a great deal of interest. And now what we've done is we've taken a short list of potential candidates from there, and we've put them into the next phase, which is further due diligence and start of negotiations, with the aim of hopefully completing this process towards the end of Q1 next year. So I know it looks like it's taken a little bit of time, but these things do when you're looking for the right sort of industry partner. But so far so good, and we're progressing. We're into the next phase.
And of course, it's got to be right. And you and I both know that Q1 isn't far away at all. Now, a word you used towards the end of your presentation was hydrogen. So Bacton, it's been identified as a future hydrogen-led energy hub. It's been identified by the NSTA, which is the North Sea Transition Authority. Mm-hmm. So what role can you see Hartshead playing in the future of Bacton? Well,
given where Bacton is and where our assets are in the Southern Gas Basin, as I mentioned, it's been a producing gas basin for many, many decades. And so there's a great deal of infrastructure in there. There's also a great deal of infrastructure in terms of renewable energy in the Southern Gas Basin now, with various wind farms, etc., which gives us access to renewable electrification. But I think that as the whole concept of the energy hub develops now with Bacton, I think that one area that we could be involved in the future is in terms of blue hydrogen, where Hartshead's gas may be used as a feedstock in the future for the production of blue hydrogen at the Bacton site.
Okay, you are the Chief Financial Officer. I do have a finance-related question for you, because in addition to the farm-out process and industry partnering, where else might you source the required development capital for the phase one project?
Well, we see the farm-out process and establishing a partner for the phase one project is a critical component of the development, because they will bring development capital to that. However, we recognise that there will be a likelihood of some residual development capital required by ourselves, and there are several sources for that. The first one is the corporate bond market, which we've seen some of our peers in the UK Southern Gas Basin access in the past. There's also reserve-based lending, because on our phase 1 assets, we've got 2p reserves now. So the lending banks would be interested in lending us money against those reserves. And then there's also the off-takers, such as BP Trading, Engie, Shell, and some of the commodity traders who off-take the gas, and they can put in prepayment facilities to assist your development capital. So we've got several forms of capital that we can access in terms of getting the right development capital for these projects. But the first one and the most important part of it is finding the farming partner and getting that particular part of the development capital locked down.
Okay, and we know that that decision is going to be sooner than we
hopefully
think.
Yes.
Andy, it's been an absolute pleasure. We've run out of time, unfortunately, but Andy Matharu, Chief Financial Officer of Hartshead Resources, thank you very much indeed. Thank you.
Thanks so much, Sarah. Bye-bye now. Bye.
Bye. Okay, everybody, it's our final presentation of today's event and the last webinar of the year, unfortunately, but it is Botala Energy. It's a relatively new entrant to the ASX. It's quite young, founded in 2018. Collectively, though, the expertise on the board isn't as young, as we'll find out. It's currently developing hybrid projects in Botswana and developing the Serowe gas project and solar opportunities. Kris Martinick is the chief executive, and he's from a more recent millennium, not the one that I referenced earlier. Thanks very much, Kris. Sorry, I'd aged everybody by centuries.
Yeah, that's no problem at all. Nice to see everybody. I'll just share my presentation now. Okay. Good evening. Oh, good evening for us here in Australia. Hi to everybody based in Europe. Look, yeah, I'll be presenting Botala. Botala is a Botswana-focused energy play, and normal disclaimer. I'm sure everyone's had a quick read of that. Our primary focus is to be a diversified energy company. As I mentioned, we're based in Botswana, Southern Africa, so we are looking to develop clean energy projects and solutions in the region. It's a great jurisdiction, taking advantage of the great electrical infrastructure and road infrastructure in the region. And we're looking at the development of the underexplored and underdeveloped coal bed methane field in combination with solar. Obviously, our vision is to be a profitable energy company. Key to that is providing Botswana with access to affordable and reliable energy. So if anyone is aware of the energy crisis that is going on in Southern Africa with the likes of Eskom and its failures at the moment, you'll be well aware of the growing need for diversification of the energy portfolio. So that's our key focus. We've got great infrastructure that it runs all the way from Cape Town to the DRC, fantastic power lines, etc. We're looking to tap into that market and diversify Botswana away from its reliance on Eskom. Just a quick corporate overview. As mentioned, we originally started this company back in 2018. Up until now, it's been privately funded. So between the board, we've invested close to $3 million of our own money in this project. We then took it to the market this year and listed on the ASX. So the major shareholders are ourselves in the directorship and key management, as well as our top 20 shareholders owning close to 70% of the project. So we've got a very, very tight shareholder group at the moment, which has well and truly supported us through our seed project, where we drilled our 4 initial wells to have a discovery in this area. So right now, ASX portfolio, ASX use of funds. I'll go into this in a bit more detail, but we're currently doing flow testing on one of the wells that we had explored earlier, and continuing with 2 exploration wells. Also, recently we announced a binding MOU with Solar Finland, who would be our partner to develop hybrid gas solar projects in the region. And we're also exploring the option of opening a manufacturing facility in Botswana. So this just gives you a quick brief overview of the region and where we're at. You can see it's relatively flat. So that was a quick flyover of our Sarawi 3 well site. So we drilled Sarawi 3 last year. It's been our best well to date, and we are currently flow testing on that well. We listed on the ASX July this year. We raised a further 5 million. We've been using that towards the development of coal bed methane in Botswana, together with solar. We are focused heavily on a cleaner, greener energy mix. Primarily at the moment, energy is generated through coal in Botswana. There are no renewables actually in the grid in that area. They import the remainder from South Africa and a little bit from Zimbabwe and as well as Zambia. So we see that as a big market opportunity to develop clean, reliable energy sources. We are the 70% owner of the project, and we are the operator. Pure Hydrogen is an ASX listed company. They are we farmed into their project originally, and we took over operatorship. So they're an ASX listed company that is heavily focused on hydrogen production and clean energy projects here in Australia, as well as converting their coal bed methane assets to hydrogen. So some good synergies that we have with them, and a great working relationship that we'd like to bring into Botswana once we prove up more of the gas. So we recently had, as part of our ASX listing, we got our resource upgraded in terms of independently certified resource. We increased it to 317 BCF 2C. So that's from the original, when we first farmed into the project, it had an independent resource of 23 BCF. So we've done quite a fair bit of work privately before we took this to the market. So I'd say we fairly well de-risked it in that exploration way. We're now moving into the appraisal phase. So we have drilled Sarawi 6. We drilled Sarawi 3. We've just recently drilled Sarawi 6. We completed that last week, logged it last week. We're about to spud Sarawi 7 probably over the weekend right now, just finishing off some pads and some bits and pieces and moving the rig from Sarawi 6 across. Flow testing, as I mentioned, currently underway at Sarawi 3. Primarily what we're looking for at this stage is the water flow rate to understand permeability within the Sarawi 3. So just to give everyone a bit of an idea, we have Botswana. It's located north of South Africa. It borders Namibia, Zimbabwe, and it has also a close relationship with Zambia at the north there as well. So we've got our fields halfway between Gaborone and Francistown in the culturally sensitive, well, not culturally, the area where the kings of Botswana have all come from is Sarawi, and the first ever Prime Minister, Sret Sikama, comes from the town of Sarawi. And so it has a lot of cultural significance. They love the project to date, so we've had a great amount of community engagement. We're very advanced in our environmental impact assessment, so we should be having our scoping study out in the next while. Actually, I'm reviewing that tonight. So right now we've got on the right-hand side, you can see that we've drilled 5 wells. We've actually now just completed Sarawi 6. We're about to move on to Sarawi 7 and spud that one. So the 6 was a 3-kilometre step out from Sarawi 3. And we're now going back into our PL19B, which is that funny little triangle on the left there, where we originally drilled Sarawi 1, and we're doing a step out from that. So we're essentially trying to link the coal seams from Sarawi 1 all the way to Sarawi 2 and 5, and that'll give us that'll give us a better idea of how consistent the coal seams are. So we're seeing 3 layers of seams here. Originally, we had only ever chased the top seam, which is the Sarawi coal seam. But as a result of 2 and 3, we actually noticed when we drilled a bit deeper that we had 2 very good coal seams below our seam, which was the lower Morapuli and the upper Morapuli. So since then, we've been going back and drilling to see all 3 seams. Hence 7, we're going in there to really test and drill a bit deeper. Then we went on Sarawi 1 and see if we can find the lower Morapuli in that area. Currently doing the Sarawi 3 flow testing. So this was commissioned earlier in November. We reamed it. So we took the well from a 7-inch ore, we turned it into 10-inch. That's given us a bigger surface area. We are currently producing water at a fairly stabilized rate, which is about 60 to 61 barrels a day. That's triple the amount of water that we were expecting. So we're fairly happy with that. That's showing a far better porosity and permeability than we originally thought we might have had. And we're currently really slowly drawing that down. So with coal bed methane, not everyone is aware of how you operate this, but you really want to treat the well very, very gently. So you gently reduce the water and let the gas release from the outside of the coal and flow through the cleats, etc., and then come to the surface. So we're expecting that we'll draw this down over the next couple of months. Maybe early in the new year, we'll have our water down over the coal seams, which should start generating some gas and give us an indication of the gas flow rate potential from a single well. This data is key to us. It gets used in the design of our commercial pilot program, which we are scheduling for March, April next year, which will be 4 additional wells drilled around this well, all combined to make a commercial pilot well. So current exploration appraisal program, we're doing the Sarawi 3 flow testing. We've drilled Sarawi 6. On the flow testing, what is key to us is the water flow rate. As much as we want to understand the gas, we need to understand the water, because that helps us design our topsides for the commercial pilot program. That'll now be 5 wells, so 4 additional wells around Sarawi 3, 5 wells all combined together for a commercial pilot. So that'll start March, April, as I said, next year. Sarawi 6, we've just drilled 7. We're about to spud. We've got the logging results for 6. We got 30 meters of coal, which was great. We're now going to do 7, and we'll then move the small flow testing kit we've got on 3. We'll move to the best of 6 or 7, and we'll test the water flow rate, and then we'll set up for a second commercial pilot program in the second half of 2023. Following that, we will actually do 2 further exploration wells by the end of next year. We want to test some further outlying regions, so they'll be a bit more higher risk, but they could really extend our geological understanding. We know we have some analogues in the area of wells that have been drilled and have hit success, so we're keen to see some results on our side of the prospecting licenses. As mentioned, we have a binding MOU with Solar Finland. With this, we are looking, when we started our journey in the coal bed methane space, we always wanted to be a reliable and cleaner energy producer, reduce our carbon footprint. So we've always wanted to team up with a solar manufacturer or solar company, someone with an EPC background or the likes. We found Solar Finland. They're very keen on establishing themselves in Southern Africa, and they provide us with a skill set that we do not have, having been, most of us are either mining or oil and gas background. So we've teamed up with Solar Finland. They're very keen on some solar projects in the region. Not only that, they've also given the go-ahead to start to build a business case looking at solar manufacturing in Botswana. Now we're fairly well advanced in terms of understanding this. We're building a business case. We've gone out with some expressions of interest to many funding partners, and we're building the idea up that hence we should be able to move into our second stage of our solar panel manufacturing project early next year. So right now we've been in the expressions of interest phase, and we're getting those back, which has been really good. And we've also applied for a special economic zone status over the area, because the manufacturing of solar panels, it meets a lot of the criteria within the national strategies of Botswana, the integrated resource planning as well. So it ticks a lot of boxes for local job creation, as well as the potential to export the panels into what is a huge market. So we'll start to, once we have our ownership structure, as in who are the ownership group of the solar panel manufacturing. Right now there's 4 of us. I can't disclose who the other 2 are, but right now it's Solar Finland, and we'd be looking at building a final investment decision by Q1 next year. That'll get us the ability to start looking at some construction later in potentially 2024 with the first tranche, which would be 100 megawatts per year of solar panel manufacturing, with an option to go to 200 megawatts. So just blue sky where we're looking at, because obviously we need to work out how we can commercialize the gas, which is our primary commercial function, is to just explore the gas field and develop the solar power generation in hybrid solutions. So we'd love to have a big, 700 megawatts producing all sorts of gas and electron products. So that's our far right. That's our phase 3 where we want to get to. But we're very pragmatic in this company, and we understand, we've got to do a pilot project and we have to prove this up. So we would define ourselves moving into phase 0, and that really is a 20 megawatt just gas and solar hybrid plant near the town, or actually in the town that is the nearest to our project site. We have a 110 hectare site that we've picked up there in Sarawi. We have a great relationship with the local landowners, and we are already establishing ourselves in that area through connection studies, grid studies. So we've recently been talking with Botswana Power Corporation on how we can actually get those electrons into the market. And then we'll move into a staged approach to eventually get to something far larger. But this just highlights that we do have a commercial plan that we're looking at, how we can commercialize the gas, and then primarily be through electrons. And the development at some point in probably CNG or most likely LNG to truck the gas out of the area. There's a lot of mines in the region, a lot of West Australian, actually ASX-based companies in the region as well, looking at reducing their carbon footprint. So moving away from diesel to gas and or hydrogen and renewables. So we're looking at some hybrid projects where we might be able to support some of our fellow ASX-listed companies. And that is my short presentation.
Many thanks indeed. So if you can just stop sharing your screen for us, Kris, that would be great. So you've certainly got your work cut out for you since you're reviewing the scoping study tonight.
Yeah. It's only 108 pages. Easy.
So we're expecting the investor update, the investor announcement on the ASX tomorrow, then, are we?
Yes. So no, we've been very busy. We've done a lot of community engagement. We've actually met with all of the Kotla, which is basically the tribal groups. So we've met with all the chiefs in the region. We've listened to all the impacts. We've listened to all their concerns. And we've got a lot of ground support for the project. People in the area, it's a great country to be in, Botswana. Very well educated, very well trained, but significant lack of jobs. So, you know, people there are desperate for employment and employment opportunities, and we think we can really help. Yeah, and it's simple things as well. When you look at people burning plastic for heating and cooking, I always thought it was wood, but you know, you head out to places like Sarawi and you can smell the plastic being burnt.
Yeah, and that's going to lead to a health crisis in its own. So this project is very, very important. Right at the beginning, you referenced this, because whilst the angst about the current energy crisis is focused on the impact on Western economies, it's the developing nations which are actually feeling the full force of the ill effects.
You're right. Yeah, who are we also to drive an agenda that needs to be 100% renewables for these guys when they have this resource that they clearly want to develop, and they have every opportunity to develop. But let's take some lessons learned from our area and not drive the full hydrocarbon agenda, and at least get the renewables into the mix earlier. Unlike Australia here, we're having a bit of trouble trying to get more renewables up and running. I'm not really sure why. But, you know, we can really help drive that agenda to help use and make sure that gas is used as a transition fuel, and also to provide some independence to the country who, you know, you're looking at the Eskom just recently increased the tariffs. I think it's this year by 22%. And, you know, that's 40 to 60% of the energy mix on a daily usage. So.
Talking about renewables, you do move in high circles, because on your LinkedIn I saw a photograph of you with the Prime Minister of Finland, Sanna Marin. So what did the pair of you discuss?
Well, she was lucky to catch up with me, actually. Look, really just to talk about the ties between Finland, but also more Scandinavian countries and the companies there. You travel to Finland and you really get your eyes open to the level of, I guess, there's so much coming out of there in terms of all through the cyber, anything that's in the computing space. Just amazing how innovative they've become, and really they've propped themselves up in such an amazing way, working with universities. So I think, you know, there's some great ways that we can combine Finnish universities working with Botswana universities. So we've been very actively engaged in discussions now, trying to link the likes of the Botswana, Buist and Batir, which are the two main universities there, and then discuss how we can link them with Finnish universities. Because in Finland and in Scandinavia, they very much take it quite serious that you know, a lot of the IP comes from the universities, and they engage them as the academics as well. So I was very impressed with Solar Finland when I first met them, and hence, yes, meeting with I was lucky to go to dinner the other day and meet with the Finnish Prime Minister and discuss these sorts of opportunities.
Very good. Two more questions, if I may. I was struck by the gentleness of your language when you were talking about dewatering the coal within the coal bed methane process. But I was just thinking about water as a commodity. Is there any chance that there's going to be so much water that it could be reallocated towards the community, or it's not economically viable?
No, you're spot on. And we're doing a lot of study work at the moment on the salinity of the water, and how we can combine it, and what are some of the species of vegetation that we might be able to grow. What are the levels of agriculture that we can do with livestock. We actually just drilled a water bore in Sarawi at our location, and we're getting really good clean water. How can we start to establish agriculture agriculture is great, we produce food for the local community, but it's also a labour intensive industry, so we can employ a lot of people to use it. But when we need clean fresh water, we can only use saline water for so long before the salt builds up in the soil. You need to flush it with clean water. So in the case of agriculture, we'll do those sorts of tests to work out how we can use what is an extremely valuable byproduct and generate jobs and generate food, but also, it gives us a way to get rid of the water. As you mentioned, it is a byproduct, and being realistic, it is a salty byproduct, but it's actually not too bad. We're sort of getting, it's far less than seawater. So yeah, we'll look at ROs once we get big, and then we'll have to work out what we do with the brine. So a lot of issues, but we'll face them when we get to them.
Yeah, issues or opportunities though. Very finally, you've got a number of options as to how the gas is sold and used. I'm thinking about an offtake deal with the nearby Arapa power station. That's an option.
Yeah, look, Arapa is an option. They've got a 90 megawatt established power station that was built 2011. It's always run on diesel. There was a gas discovery back then. Unfortunately, that was never commercialised. And since then, it burns for 30 minutes a day, roughly, on diesel. And it's used as a bit of a peaking energy plant. So yes, there's a gas flange ready to go. And look, if we don't win that contract, we will be the masters of our own destiny. And we've got 2 downstream locations, Lupani and Sarawi. So Sarawi is 110 hectares in the town of Sarawi, and Luapani is another 40 kilometres, but that sits on the A1 highway, which connects Botswana to South Africa and Zimbabwe, and it also has a 400 kV and 220 kV lines running through it that are in great nick. So if you're going to put a power station somewhere, I'll move my gas to that point, and we've got, like I said, 1,500 hectares there. We've got more than enough space. And what we're positioning ourselves up for is, let's set up our manufacturing hub there and invite other industrial players to move into that region. So we're on that 1,500 hectares site. We're at the moment going through change of land use and applying for it to be a mixed use, not just agriculture, but for actual industrial use, where we can invite other clean energy players to come and set up shop. We'll do all the environmental work. You guys come and join us. Very good. An industrial hub. That sounds very zen, but we must reinforce the message. You are in alignment with shareholders. A lot of the family money's gone into this, so yep. I'm quite sure that you will make this work. Kris, Martinick. Oh, we will. Thank you very much. Chief Executive. Thank you very much for your time. You're welcome. Thank you. And thank you for everybody who's been watching. So thank you, Kris, Andy, Ian, and Callum, and to Master Investors, Sophie Keeley, for organising this, and for Master Investor. Do check out the Master Investor website for future events. And I want you to bookmark this date. It is the 18th of March, which as of today is a glorious 100 days away. We will be back at the Business Design Centre. The Master Investor Show again is back. You just can't keep us away. Thank you very much indeed. Take care. And from us all here at Master Investor, a very Merry Christmas.